So what's happened is the economy, after that little brief blip of activity, has slowed right down. It's all gone wrong. And this is 20% of the global economy, and it's just gone wrong. So where are we headed? Well, you get 3 economists in a room, you're going to get 4 opinions. The W, back into a double dip. U, blah, recovery. V, robust rebound. There are no V guys left. The V guys have largely disappeared. You're really down to the U or something worse. Now, I would say that I am more confident today than I was a month ago, 2 months ago, 3 months ago, that there's not going to be a double dip. There's been a little resilience in the US data of late that makes me think that, well, double dip, I think, is a relatively low probability and getting lower. There is a little resilience in the US economy. So it's probably going to be something, better than, we're going to avoid the double dip, but we're not going to grow very fast. I'm going to just discuss 2 reasons why. One, we have destroyed a lot of household wealth. Okay, about $14 trillion worth of household wealth was lost in the Great Recession, and you can see that that has caused consumers to raise the saving rate. And at this stage of the recovery, that's normally falling. So what happens at this stage of the recovery is that the saving rate should be dropping, and that means that you're going to be consuming a larger portion of your income, and that drives the economy up. That's going in the other direction. And next, we can't get the labor market fixed. This is a measure of job shedding. All right? Right now, it should be down around 300. That means 300,000 new filers every week. We're stuck at 450. Now, the old rule of thumb is 400 is consistent with recession. So we can't even get down to the level that's consistent with a normal type recession. This is a major problem. Think of the circle of flow of income. You get demand, goes to production, goes to employment, goes to income, comes around to give you more demand. Right? Economics 101. Now, the employment is broken, so the circuit doesn't complete. So those are the 2 big problems facing the US economy right now. And I think what we have concluded is that we are going to get a sustainable recovery, but it is going to be anemic, lackluster by historical standards. In fact, by historical standards, this is something worse than a half-speed recovery. There's a very clear relationship between the depth of a US recession and the strength of the forthcoming recovery, and this is not working this time. So we are doing something in the United States that we haven't done before. We are putting together a lousy, deep recession with a mediocre, anemic recovery. And that is unfortunate indeed. And it means that the unemployment rate is going to be elevated for some considerable time. We're at 9.6 now. I don't think we're going to be, I don't think it would necessarily be, it'll be high 8s this time next year maybe. I mean, we're not talking, about any kind of real recovery. Inflation is very low. And at these kinds of levels of unemployment, if you believe in the Phillips curve, then you have to worry about deflation. The third factor is the Fed isn't going to tighten anytime soon. Not in 2011. I wouldn't even bet my firstborn on the first half of 2012. It's going to be a long time before the Fed even considers raising interest rates. Here you can see the deflation story, or the inflation story currently, but coming. Look at that. Now, just compare those 2 shaded areas, right? The one to the left is the mildest recession in post-war US history, and look what it did to inflation. This is the deepest recession in post-war US history. I don't know about you, but you have to consider the possibility of deflation under these circumstances, and that would really complicate the Fed's job. Just ask the Bank of Japan. So, on the three fundamental problems, China, don't worry. Europe, worry, but it won't disrupt. It won't derail the recovery. And third, on the US, lackluster but sustainable economic growth. And that means that the global recovery continues. Now, how could you possibly make money on this? Well, let's talk about what's happened in markets, financial markets, over the last 2 years. It's all been about risk on or risk off. Right? You put risk on, you buy equities, you sell sovereigns, you sell the dollar. You take risk off, you sell the equities, you buy the dollar, and you buy the sovereigns. And pretty much, if you look at the price action of the last 2 years, and I think one of my colleagues on the panel showed this chart. Here you go, risk aversion Lehman. Risk appetites recovering until the spring of this year. The spring of this year, people realized there was a European debt crisis, China was tightening, and the US was faltering. And you can see that sort of swoon. It didn't last very long. And in the latest part of this, you can see that there's been a simultaneous recovery in stocks and in bonds. You can see the bond yields continue to go down. That was about Fed easing. And you can see here, risk aversion, bond yields fall, risk appetites revive, bond yields rise, and so on. So you get this, you get very much this, and then finally the dollar, look at the dollar. The dollar surges, sells off, jumps briefly, and then sells off on Fed loosening. This kind of risk on, risk off, I think, is with us for the foreseeable future. So if you believe my basic underlying view of the world, equities should grind higher. Right? We've got a sustainable recovery going on, albeit lackluster, but corporations are flush with cash, they're making profit margins are high, they are flush with cash, and valuations still appear fair with fairly good expectations for next year. So I'm not thinking that equities are going to shoot out the lights, but they should grind higher. And there's a lot of market correlation here. As you saw in those earlier charts, equities are correlated. Sovereign yields, I believe that they will probably edge up, but, and here I'm talking about globally, not necessarily European peripherals, but only moderately. With inflation this low, policy stuck at this very accommodative mode, and growth anemic, I don't believe that there will be any major rise in sovereign yields, but I can't see them really going a lot lower in my scenario. If you say, hey, we're going to double dip, then maybe. But in this scenario, I think it goes up. The dollar has to remain weak because the Federal Reserve is probably going to be the most accommodative of the central banks. Your European central bank is creeping to the exits. And they would go a lot faster if they could. There's something in the water in Frankfurt, I think. Anyway, the dollar, I think, will remain fairly weak. Now, let's go on to a few other things. I think emerging market equities have to continue to outperform in this environment. So you can see here that they have outperformed very handily over the last decade. I cannot believe that they will not continue to do so for the foreseeable future. But of course, with a little bit of volatility. And notice, I'm talking about emerging markets. Most people say, immediately get the idea, oh, that must be Asia. No, Asian economic outperformance has not translated into Asian equity market outperformance. That's a broad-based equity, emerging market equity basket. I agree with my colleague here on the panel. I like corporates. I like corporates because I believe that we're in an in-between recovery. Our recovery is not so weak that credit spreads would blow out. It is not so strong that the riskless rate would rise, and therefore I feel pretty good about high yield and corporate or credit risk. And my final point is that if you believe that the world will in fact continue to expand, albeit modestly, then I believe equity prices, that commodity prices, like equity prices, will grind higher also. I think that we will hit $90 on oil in the spring. That's a seasonally fairly strong time for oil. I keep thinking about 90, and then I think probably edging up thereafter. But again, with a fair amount of volatility, and the slope of the line is relatively shallow. So I thank you all very much indeed for your time and attention today. I hope you found it was worth waiting for.